students, now we'll continue our session. Previous session we have completed problem number 16. Now we'll start problem number 17. Problem number 17. Now see the problem. Rate of return and the risk of three growth firms are given below. Rank the firms by Sharpe's index of portfolio performance, assuming risk-free rate to be 9%. So we have to give the ranking according to Sharpe's measure. The growth firms are Anushka, Amba and Aishwarya. The rate of returns are given RP. Risk is given standard deviation. So we'll start. Sharpe's performance index SP. The formula is RP minus RM divided by standard deviation. Return divided by total risk. Reward divided by total risk. From Anushka, SP is 0.41. 16% is the portfolio return given. Risk-free rate is 9% and standard deviation is 17. So 0.41 for Amba it is 0.26. For Aishwarya it is 0.33. So simply we have to substitute RP values, risk-free rate and standard deviation. The ranking of firms will be Anushka first rank, highest value is 0.41. So first rank Anushka, second rank Aishwarya 0.33, third rank Amba 0.26. That's all. This is the problem number 17. Now problem number 18. See the problem. Consider the following information for three mutual funds A, B and C and the market. So we are given three funds A, B, C. For each fund we are given the mean return. This is the portfolio return, fund return. Standard deviation is given, beta is given. And market index is also given. So market return is 11% and market standard deviation is 17 and market beta is always 1. The mean risk-free rate was 6%. Calculate the Trainer's measure, Sharpe's measure and Jensen's measure for the three funds and the market index. So we have to calculate the Sharpe, Trainer and Jensen for all the three funds and also for the market. So one by one we'll take. First we'll take Trainer's index. The formula is TP is equal to RP minus RM divided by beta. So here we have taken standard deviation, here we will take beta. So fund A, numerator will remain same. Numerator 12 minus 6. 12 is the return on A and 6% is the risk-free rate. And the beta is given as 1.10. So 5.45. So fund B, it is given as 10% mean return, 6% risk-free rate and beta value is given 0.9, 4.44, fund C 5.83. And market return is 11%, risk-free 6 and market beta is 1. So these are the index according to Trainer's index for fund A, B, C and market. So if you compare this, the highest value is 5.83. So fund C is performing better than the other funds and the market. Market से भी better performance C fund का है, ठीक है, market से ज़्यादा है इसका index. उसी तरह 5.45. Fund A is also performing better than market, but fund B is performing less than market. This is the conclusion from this Trainer's index. Now Sharpe's index SP is equal to RP minus RF by sigma P. Standard deviation, denominator. So fund A numerator will remain same, 12 minus 6. Denominator will take the standard deviation of A, that is 18. So fund B, 10 minus 6 by 15. Fund C, 13 minus 6 divided by 20. And market it is 11 minus 6 divided by 17. So now we compare it. The market index is 0.294, whereas the C highest value is 3.5. Fund C is performing the best compared to market. Even fund A also performing better than market. Fund B is performing less than market. So same conclusion we are getting in Trainer's measure and Sharpe's measure. Now we'll come to the Jensen's measure. RP minus RF is equal to alpha plus beta into RM minus RF. We substitute the values, we get the alpha 0.5 for A, minus 0.5 for B and 1 for C. 1 for C. Again, according to the market index, always alpha will be 0. Always the market measure will be 0. Now, C fund is much better because positive. Then A, then B. So the conclusion will be same for all the three measures, Sharpe, Trainer and Jensen's. Conclusion ये है कि fund C is the best fund compared to market. Second rank will go to fund A and last rank will go to fund B. That is the conclusion for this problem. So we have completed 18th one. Now we'll take up the next problem, that is 19th one. 19th problem. See the 19th. Analyze the performance of the following portfolio using the Jensen's model. Given risk-free rate is 6%. The portfolio 1, 2, 3 realized return on portfolio beta. Market portfolio is also given, right? We have to apply only Jensen's index. So Jensen's index is this is the equation we use for Jensen's measure. Now one by one, portfolio 1. Portfolio 1 RP is given as 12.5. Risk-free rate 5. Risk-free rate is 6. Alpha we have to find out. Beta is given 1.10. Market return 10 minus 6. So 12 minus 6.5 is equal to alpha plus 1.104. So 6.5 is equal to alpha plus 4.4. 6.5 minus 4.4 is equal to alpha. Alpha is equal to 2.1. This is for portfolio 1. Now portfolio 2. 9.5 minus 6 is equal to alpha plus 0.9 into 10 minus 6. So 9.5 minus 3.5 is equal to alpha plus 0.9 into 4. 3.5 is equal to alpha plus 3.6. Minus 0.1. So 3 portfolios we have completed. Now 2 portfolios. Now portfolio 3. The return is 15%. 15 minus 6 is equal to alpha plus beta 1.40, 10 minus 6. 15 minus 6 is 9. Alpha plus 1.40 into 4. 1.40 into 4, 5.6. So 9 minus 5.6 is equal to alpha. Alpha is equal to 3.4. So we have calculated the Jensen's measure alpha for portfolio 1, 2 and 3. So for first portfolio, we are getting alpha 2.1. Second minus 0.1, third 3.4. So conclusion you have to give, the best portfolio is portfolio 3. Since its alpha, since the value of alpha is the highest, 3.4. Second rank goes to portfolio 1 and last rank goes to portfolio 2. That is the rank. This is problem number 19. Now the last problem, 20th. Problem number 20. See the 20th problem. 6 portfolio experience the following results during a 7-year period. So 6 portfolios are given A, B, C, D, E, F. Now annual average return, this is the portfolio return. Standard deviations are given, correlation with market. This is the first problem where correlation is given. Why correlation is given? By using this correlation we can be able to calculate the beta. By using a formula of correlation we can find out beta values. The beta values directly is not given. We have to find out the beta by using correlation, by using one formula. Then we are given A, B, C, D, E, F, 6 portfolios. Then market returns are given 13%, 12% standard deviation, and risk-free rate is 9%. Rank these portfolios using Sharpe and Trainer's method. Sharpe method to standard deviation दे दिया, directly we can calculate. For Trainer's measure we need beta values, and by using correlation coefficient we can find out the beta. Then we can calculate Trainer's measure. So first we calculate Sharpe's index, 20th problem. SP is equal to RP minus RF divided by standard deviation. Portfolio A. The return is given 18.6 minus 9 divided by 27. It is 0.356. Then portfolio B. SP is equal to 15.1 minus 9 divided by 8. 0.7625. Portfolio C. SP is equal to minus 9.0 minus 9 divided by 4.0. It comes to minus 4.5. Portfolio D. For 6 portfolios we have to find out. Portfolio D. B is 14.8, sorry. It is 14.8 minus 9 divided by 18. It is 0.322. C is 15.9. 15.1 minus 9 divided by 8. It comes to 7625. 0.7625. Now portfolio D. SP is equal to 22 minus 9 divided by 21.2. 0.613. Portfolio E. Minus 9.0 minus 9 divided by 4.0. Minus 4.5. Lastly, portfolio F. 26.5 minus 9 divided by 19.3. 0.9067. That's it. So we have calculated the Sharpe's performance index for all the 6 portfolios A, B, C, D, E, F. Now beta. Calculation of beta. There's a formula for beta. Beta is equal to R into standard deviation of P divided by standard deviation of M. See here, whenever beta is not given, we can find out the beta by using this formula. The formula is beta is equal to R. R stands for correlation coefficient. Correlation coefficient into standard deviation of portfolio divided by standard deviation of market. So one by one we'll calculate A. Beta is equal to R. What is the correlation of R? 0.81 into standard deviation of portfolio is 27 by 12. It comes to 1.8225. Then B. beta is equal to 0.65 into 18 by 12, 0.975. C, beta is equal to 0.98 into 8 by 12. See here, we are taking the portfolio standard deviation in numerator and market standard deviation in denominator. The market standard deviation remains same. Only portfolio standard deviation will change, correlation will change. So C value 0.653. D, beta is equal to 0.75 into 21.2 divided by 12, 1.325. E, 0.45 into 4 by 12, 0.15. F, beta is equal to 0.63 into 19.3 divided by 12, 1.013. That's all. So we have calculated the beta coefficient for all the 6 portfolios. Now our problem has become very simple. Now we can easily calculate the trainer's measure. TP is equal to RP minus RF divided by beta. So fund A, portfolio A. TP is equal to, what is the RP value? 18.6 minus 9 divided by beta is 1.8225. 18.6 divided minus 9 divided by 5.267. Portfolio B, TP is equal to 14.8 minus 9 divided by 0.975 is equal to 5.949. Portfolio C, TP is equal to 15.1 minus 9 divided by 0.653 is equal to 9.342. Portfolio D, TP is equal to 22 minus 9 divided by 0.613. Beta value is 22 minus 9 divided by portfolio D, 1.325. Portfolio E, TP is equal to minus 9 divided by 0.15. Portfolio F, TP is equal to 26.5 minus 9, 1.013. 17.28. And E, it is minus 120. And D, we will calculate 1.325. D, 0.75 into 21.2 divided by 12, 1.325, right? 22 minus 9 divided by 1.325. It comes to 9.81. 9.811. We'll see the calculations once. 0.81 into 27 divided by 12. It is 1.8225, right? 0.65 into 18 divided by 12. 0.975. 0.98 into 8 divided by 12. It is 0.653, right? 0.75 into 21.2 divided by 12, it is 1.325. 0.45 into 4 divided by 12, 0.15. 0.63 into 19.3 divided by 12, that is 1.013, right? All the calculations are right here. Here also we'll check once. 18.6 minus 9 divided by 1.8225. 97 point. Here there is a difference, right? 18.6 minus 9 divided by 1.8225. 5.267, right? 14.8 minus 9 divided by 0.975. 5.949 by 15.1 minus 9 divided by 0.653. 9.342, right? 22 minus 9 divided by 1.325. 9.811, right? Minus 18 divided by 0.15. Minus 120. 26.5 minus 9 divided by 1.013. 17.8. Right, all the calculations are right. Already I have made the calculations, but some mistake I have done. Now it is exactly correct. So these are the calculations of Sharpe's index and Trainer's index and calculation of beta. That's it. So rank these funds. After this, we have to give the ranking. We have to prepare a table and give the ranking. Lastly, so how to give the ranks? Portfolio. We'll take the portfolio in the first column. Portfolio. Then two broad columns will make. One for Sharpe, another for Trainer. Index, rank. Index and rank. So portfolio A, B, C, D, E, F. Now we'll write down the index. What is the index? 0.356, 0.322, 0.7625, 0.613, minus 4.5, 0.9067. Similarly, the index for according to Trainer is 5.267, 5.949, 9.342, 9.811, minus 120, 17.28. That's it. We have taken indexes. Now we give the ranking. The highest index according to Sharpe is 0.9067, first rank. Second rank will give below 0.9067 is 0.76, second rank. Third rank is 0.613. Fourth rank is 356. Fifth rank is 0.322. And last sixth rank is E, minus 4.5. Similarly, we have to give the rank according to Trainer. Highest value is 17.28, first rank. Below 17, it is 9.8, second rank. 9.3, third rank. 5.9, fourth rank. 5.2, fifth rank. And last one, sixth rank. That's all. These are the ranking according to Sharpe and Trainer. Okay students, we have completed 20 problems in this portfolio evaluation. This is the end of the subject investment management. Particularly this investment management subject we have discussed according to the syllabus of Osmania University 4th semester investment management syllabus. So totally 5 units we have covered. If you have followed all these 5 units, definitely you will get a good grasp on the subject investment management, not only from examination point of view, but also to improve, to increase your knowledge on the subject. Because right now, The market is very competitive. You need the knowledge to find a place in the market. Competition is very stiff now. Only the fittest can survive in the market. So don't keep your narrow objective of just passing the examination. It's not at all difficult. Easily you can pass the examination, easily you can get the degree. But the thing is, you must have confidence on the subject. Not only on this subject, but all the financial subjects. So I have started this, online videos during this pandemic period to give more and more knowledge to share my knowledge with all the students so that it will be helpful to all the students. So in the first unit, we have covered up the investment introduction, meaning of investment, types of investment, investment process, and what are the factors to be considered while making the investment. Then we have discussed about differences between investment and speculation. Then we have discussed about how to calculate the return and risk of securities, covariance and correlation of securities. We have discussed about the approaches to fundamental analysis, investment analysis approaches. Two approaches are there, that is fundamental analysis, technical analysis, and efficient market hypothesis. In those videos, you can go to the initial videos, listen that videos carefully. You can be able to get a good grasp on the first unit. Second unit, we have discussed about fixed income securities, bonds and debentures. How to calculate the value of a bond, because valuation is also one of the step in the process of investment. इन्वेस्टमेंट प्रोसेस में एक स्टेप वैल्यूएशन ऑफ सिक्योरिटीज है. अब सिक्योरिटीज को दो कैटेगरी में डिवाइड कर दिया, फिक्स्ड इनकम एंड वेरिएबल इनकम सिक्योरिटी. तो फिक्स्ड इनकम सिक्योरिटी सेकंड यूनिट बॉन्ड्स एंड डिबेंचर्स. तो हाउ टू कैलकुलेट द वैल्यू ऑफ बॉन्ड एंड हाउ टू फाइंड आउट द रिटर्न ऑन बॉन्ड. Different types of returns are there, that is yield to maturity, YTM, yield to call, coupon yield, and the current yield. Different types of yield we have done the calculations. Apart from that, immunization of bond duration, finding out the bond duration, those things we have discussed in unit number 2. We have done so many problems. Then unit number 3, we have done stock, common stock valuation and analysis. Common stock is nothing but equity. तो equity के features क्या है? What are the approaches for calculating the value of common stock? इक्विटी को वैल्यू करने के लिए कौन सा डिफरेंट अप्रोचेस है? कांस्टेंट ग्रोथ रेट मॉडल, वेरिएबल ग्रोथ रेट मॉडल एंड CAPM. all these things we have done in unit number 3. Unit number 4, portfolio theory. A portfolio is a basket of security, a combination of security. तो पोर्टफोलियो का रिटर्न कितना कैसा मालूम करेंगे, रिस्क कैसा मालूम करेंगे, all these things, CAPM, undervalued, underpriced security, overpriced security, all these things we have done in unit number 4. Lastly, unit number 5. Unit number 5, we have discussed about the mutual funds. So one video completely is based on mutual funds. Then we have discussed what are the techniques of evaluating the portfolio performance. What are the measures of evaluating the portfolio performance? Sharpe's measure, Trainer's measure, Jensen's measure. These 3 measures we have applied in order to evaluate the portfolio performance. This is the end of the subject investment management. Hope the students have enjoyed, the student have with interest they have watched the videos. From the views, from the subscribers, I get a lot of knowledge that students have been watching my videos. So keep watching, not only this subject, apart from other subject, and subscribe it and share the videos, share the links with all your colleagues so that more and more students can be able to get the benefit from these courses. All the best for your examination and also for your life, for your future.